Welcome back. Here with Money. Vishal Dhawan of Plan Ahead Wealth Advisors has been talking to us about the relevance of tax-free bonds in this scenario of lower interest rates. And well, he's given a thumbs up for it for sure. So it's time now to open up our lines to our viewers for their queries. So joining us first up is Nandita Kothari, who calls in from Mumbai. Hi Nandita, how can we help you?
Hello, I'm Nandita. I want to know about long maturity tax-free bonds offer buyback option. When should investors exercise this option?
Okay, Vishal, so what's your take?
So essentially, the buyback option on tax-free bonds is largely not available at all. Most tax-free bonds come without a call option or a put option, which essentially means that you pretty much have to find the secondary market to offload your tax-free bond holding in case you need to exit it. I think as an investor, what you need to be careful about is that you will tend to find that demand for tax-free bonds will be higher in the secondary market when interest rates are headed downwards. But when interest rates are, kind of headed upwards, you'll find that liquidity in these kind of instruments will tend to be much lower. And therefore, our recommendation very clearly is when you're buying tax-free bonds, ensure that you have another part of your portfolio which is fairly liquid, because you may not be able to come out of these in the way that you want to.
Yeah, and you may not want to in any case.
You may not want to.
All right, Nandita, I hope that advice works for you. Up next, we have an email query sent in by Ajay Saraf, who has written to us from New Delhi. He wants to know how important it is to invest in only AAA rated tax-free bonds and how risky would it be if he or any investor for that matter were to invest in lower rated paper. So it's a no-brainer that AAA would come out on tops, but is it really risky even if something were rated AA?
Well, actually there is two or three drivers to this entire thing. So one is a lower rated paper is going to end up offering you a slightly higher rate of return. And very clearly what tends to happen is, and again there are very clear guidelines on this, so typically a AA plus rated tax-free bond can actually offer you 0.1% extra. And remember that when you're talking about a 10, 15, 20-year bond, you're going to get this every year for that period of time. And a AA or a AA minus can actually give you 0.2% extra per year. Having said that, it's important to understand that the reason why the rating is lower is because there is an incremental level of risk. And I think each investor will have to figure out whether he's comfortable with taking that extra risk for a 0.1 or a 0.2% extra. What we actually find is that when there is an environment where there is risk aversion, you actually find that investors start worrying about a AA or a AA minus paper. But when things are good, they don't really worry about it. So our view is that you'd have to actually balance it out. A lot of the issuers who have got an approval for raising money in this financial year, for example, are actually AAA rated. There are very few of them who are AA plus rated, and actually AA or AA minus, there is none of them. So I typically say that you will anyway want to mix and match your issuers, and therefore look at buying some of that exposure, but be careful to track these financials moving forward as well, because I think a lot of people look at tax-free bonds as kind of buy it and forget it kind of products. Typically what happens is these companies, because you're buying 10-year, 15-year, 20-year paper, could actually see their financials change over a period of time. And what you want to be sure about is saying that just because something was AAA 10 years ago when I bought it, doesn't kind of just get forgotten, and maybe the financials have deteriorated.
Yeah, that's true. Actually, that's useful advice. So, Ajay, I hope you were listening to that, and thanks very much for writing in. Finally, a query comes in from Rajat Singhania, who's written to us from Hyderabad. His query is from a tax-saving perspective. So he wants to know if the tax on the proceeds from the sale of land as well as capital gains will be lower if he were to invest that money in tax-free bonds. So, Vishal, I'm sensing some bit of a confusion over here. Do you want to clarify that?
Yes, absolutely. So I think tax-free bonds are a completely different segment. They're essentially, long-term bonds which are issued by the government, where they're trying to kind of promote investing in infrastructure, and therefore they are pure investment products. There are no tax benefits here, no Section 80C benefit, no capital gains benefits, nothing of that kind. All that you're getting here is the interest that you earn on those bonds is available without any tax payment or any TDS. The bonds that he's probably referring to are what are available under Section 54 EC, where essentially there are a couple of issuers today who are allowed to actually raise money where investors can actually invest to save tax if they've sold, for example, a piece of real estate. So I think that's a completely different segment. The rates of return there are much lower. They are only for 3 years. It's a completely different segment, and I think it's important that investors don't confuse these two segments because they could end up making the wrong decisions.
Okay, Rajat, so that's something that you really need to be careful about, and I hope that works for you as well. Vishal, thanks very much for joining in.
Always
and
a
for
pleasure.
advising all of our viewers. Let's take a break. Still ahead is our tip of the week.